Intermarket analysis is a relationship, or a measurable correlation between certain markets. It is a form of fundamental analysis, without a time delay. Supporters of intermarket analysis state that it can be done by applying the statistical methods like correlation. Critics of intermarket analysis refute statistical methods and use only price indicators for fundamental analysis. In John Murphy's first book, published in 1991 on intermarket analysis, he used the crash of 1987 to lay out his intermarket hypothesis. Murray Ruggiero published Intermarket-Based Trading Systems in 1994. Hence, intermarket market analysis can be thought of as a type of instantaneous fundamental analysis and is not really meant to work on a tick-by-tick basis. It gives you a general bias and direction. Thus, your intermarket work looks for times that these underlying relationships are moving opposite to the market you are trading. There are many approaches to intermarket analysis, like mechanical, rule-based, while not mechanical via a different angle. One can use intermarket analysis of oil along with the intermarket analysis of other key markets to help with profitable day trading of the Russell 2000 MNIER2. There are many supporters and detractors for this theory, and the points to consider regarding the intermarket relationship have been clarified in the following sections. 1. They are tried and time-tested intermarket relationships with easily available free data and a simple spreadsheet or charting program. The quickest function to use is the simple correlation study, wherein one variable is compared with a second variable, that is the correlation between two data series. If it is positive, the correlation value shall go as high as plus 1.0, representing a perfect and positive correlation between the two series of prices. Moreover, a perfect inverse negative correlation depicts a value as low as 1.0. Readings near the zero line would show no discernible correlation between the two samples. Moreover, it is rare to have a perfect correlation between any two markets for a very long period of time, but most analysts would probably agree that any reading sustained over the plus 0.7 or under the minus 0.7 level, which would equate to approximately a 70% correlation, would be statistically significant. Also, if the correlation value went from a positive to a negative correlation frequently, the relationship would most likely be unstable and probably useless for trading. 2. The most widely accepted correlation is the inverse correlation between stock prices and interest rates. For it is a general assumption that as interest rates go higher, the stock prices go lower, and conversely, as interest rates go down, the stock prices go up. 3. A really simple concept for intermarket-based systems. For positively correlated markets, the concept is: if intermarket is an uptrend and traded market in downtrend, then buy. Or, if intermarket is in downtrend and traded market is an uptrend, then sell. Various concepts are used to define an up and down trend. If we use the price relative to a moving average, then, for negatively correlated market we have as follows. If intermarket is an uptrend and traded market in uptrend, then sell. Or, if intermarket is in downtrend and traded market is in downtrend, then buy. The views of the people who oppose the intermarket relationship along with arguments are as follows. 1. However, there is a lot of opposition against the intermarket analysis, as many who have used it are just blindly using it by optimizing parameters without giving a thought as to why a given market should work and what logic reasons, based on the premise a given intermarket relationship would decouple. Intermarket relationships are not always constant. They go through periods of ebbing and flowing. Thus, we cannot expect perfect results or answers, but what we can have some statistics regarding the market's behavior. Although the intermarket relationships does decouple at times, it does not mean that it is not valid or reliable. However, by proper research, we can analyze the reason for the decoupling and predict the same. Taking for example, in 1993, both the CRB index and the 30-year bond rallied that summer. These two markets were negatively correlated. The problem was, as the interest rates were falling, prices of bonds were rising so rapidly, which caused the effect, an intermarket inversion. Research findings states that with 2-3 sigma moves would cause these problems. The logic is that interest rates falling stimulated the economy, which caused the fear of inflation and commodity prices to rally. 2. It can be shown that many stock indexes, exchange-traded funds and even some mutual funds are useful in predicting the prices of the underlying related futures. Stock prices lead commodity prices in many cases. It can be because more money is spent in the stock analyst world, so their research contains future prediction of the underlying prices of the related commodity or futures. 4. Some points to note regarding the relationship between stocks to each other and the relationship of commodities to each other, which are totally two different aspects. As the commodities are more closely correlated. This is a global world, so if things are priced in dollars, thus what is paid would have a component in the value of the dollars versus other currencies, like the euro. Taking a simple example, you have 100 gallons of gas, you live in Germany. You want €200 for it. Assuming that the dollar is 80 cents. You require $240 for the gas. If the dollar drops to 70 cents, you require $260 in order to get your €200. Problems in the Middle East could change the value of your gas to €250, and that is why the relationship between the dollar and crude does not always work. 5. Another argument against intermarket analysis is that count matters more, which are not the Elliott's 5/3 counts. The market thus repeats a subtler, more extended series of sequences which needs to be discovered, and they will lend you greater predictive power than you've ever felt. They think that comparing related movements is beneficial, like with the Dow, S/P, and Nasdaq Comp, and is called the relational analysis. Comparing related instruments can provide clues that would otherwise remain unknown, and it is a powerful concept. 6. Moreover, the critics state that Charles Dow was about 90 years before Murray when he saw the Dow Industrials and Rails as linked, and the recent research shows that markets can and do run in similar directions and create similar oscillations, but no two markets oscillate identically, and that's what is important. If markets act conversely just one time, then their intermarket relationship cannot be trusted and can never be used to accurately determine the true trend of any market.